What is a deferred sales trust? People would have laughed at you if you'd told them a decade ago that you still don't know what a deferred sales trust is. The internet has made it easier than ever to learn just about anything you want. So with all this content and information available, how did you know which ones to learn from and which ones actually work? Luckily for you, Real Talker, for today's video, we'll be talking about what is a deferred sales trust. Remember that while the first step is completing any of this amazing video, the second and possibly more important step is taking action, even if it's imperfect action. For real estate investors and those thinking about a 1031 exchange in this hot market, Delaware Statutory Trust may be able to help you with a variety of issues. What you should know if you're thinking about buying DSTs is provided below. DSTs are special real estate investment vehicles that let a group of individual investors buy fractional interest in substantial commercial real estate assets that are typically well out of their reach as solo investors' budgets. Although DST investors own shares of a trust that was created especially to be the legal owner of the underlying properties held within the trust, they don't actually own any real estate. Instead, they own shares of a trust. The legal division it establishes between the trust and the group of DST investors make this distinction crucial. Delaware Statutory Trust are investment options for 1031 exchange and other types of real estate investors. We'll look more closely at how they operate below. We'll also talk about the significance of timing in relation to DST investments and how to research potential DST sponsors. Commercial real estate has earned a prestigious seat at the investment table alongside stocks, bonds, and cash over the past 20 years. And it's easy to see why. Greater income and appreciation potential, competitive risk-adjusted returns, and significant tax benefits are all possible benefits of CRE. But for the typical investor, commercial real estate may seem too expensive and labor-intensive. What are the best ways for smaller, independent investors to take advantage of institutional-grade commercial real estate? A Delaware Statutory Trust is becoming a more common choice. With the relatively low minimum investment cost, this investment vehicle offers individual investors the chance to acquire passive ownership in an asset of institutional quality. What is a Delaware Statutory Trust? An undivided fractional interest in the trust's holdings is held by each investor in a Delaware Statutory Trust, a type of real estate ownership structure. A qualified real estate firm known as the DST sponsor creates the trust after locating and acquiring the real estate assets. Eventually, the property will be entirely owned by the investors as their investments replace the money that the DST sponsor used to buy it. A beneficial interest in the trust is owned by investors. As a result, investors own a portion of the property and no one owner can claim exclusive ownership of any particular feature of the property. The statutes of Delaware trust law permit the creation of legal entities known as Delaware Statutory Trust. Investors in DSTs, also known as beneficiaries, are fractional owners of the trust, the legitimate owner of the underlying assets of the trust. DSTs are, however, eligible for 1031 exchanges both when they are created and when they are terminated because the Internal Revenue Service treats each investor's beneficial interest as direct property ownership. DSTs are frequently created by real estate firms known as sponsors, who choose and buy the assets placed under trust using their own funds. Individual investors buy fractional shares of the DST from the DST sponsors during an offering period, which is opened by a registered broker-dealer. DST beneficiaries are passive investors even though they contribute equity capital. Although the DST sponsor typically sets a cap of 499 beneficiaries, DSTs can theoretically have an unlimited number of beneficiaries. Significant advantages of a Delaware Statutory Trust. The DST ownership structure has a number of benefits such as tax advantages, income potential, the chance to purchase ownership in an asset of institutional caliber, and possibly, most significantly, DSTs are eligible for 1031 exchanges. By distributing their 1031 exchange proceeds among several institutional-grade DST properties, which are typically much larger and out of the price range of most individual investors, DST stands out as a 1031 replacement property option for investors seeking passive income potential and diversified risk. Statutory trust in Delaware for 1031 exchanges. A 1031 exchange, so named after U.S. Code Section 1031, real estate investors can postpone paying taxes or capital gains taxes on the sale of investment property by using a transaction authorized by the Internal Revenue Service. DSTs are qualified for tax-deferred 1031 exchanges because they qualify as direct property ownership for taxation purposes. Within 180 days of the closing date of the relinquished property, the sale proceeds must be reinvested into another like-kind replacement property of equal or greater value in order to defer tax. Tax deferral enables DST investors to keep all of the equity from the sale of their sold property, allowing them to use it to buy new DST replacement property and continue to benefit from it. Every type of property, including DSTs, functions in the same way under the basics for a 1031 exchange. However, given the strict 1031 exchange rules and deadlines, DSTs typically close within 3 to 5 business days of the sale of the property that was given up. Purchasing DST real estate. The four main property types of multifamily, office, industrial, and retail are all held as DST properties. In addition to specialized property types like senior housing, medical offices, and self-storage. DST real estate typically consists of assets of institutional quality with strong income potential. These assets would normally be out of reach for the average individual investor due to their high purchase price, which ranges from $30 million to $100 million. But they're accessible through the fractional ownership provided by a DST. DSTs can own multiple properties, but they usually concentrate on a single kind of property. An investor can invest in several DSTs to diversify among various property types. DST history. The Delaware Business Trust Act, which was passed in 1988 and later renamed the Delaware Statutory Trust Act, is what gave rise to Delaware Statutory Trust. These unique business trusts establish a secure and well-defined trust entity that is legally distinct from the trust's beneficiaries. Assets held in trust are immune from seizure or possession by creditors because the trust is regarded as a distinct legal entity from its beneficiaries. Benefits of putting money into a Delaware Statutory Trust. Due to Delaware Statutory Trust's fractional ownership structure, individual investors have access to commercial-grade real estate assets that are typically owned by institutions, insurance companies, pension funds, and real estate investment trusts. Large Class A multifamily apartment complexes, office buildings, shopping malls, industrial distribution and warehousing facilities, self-storage facilities, and other similar commercial assets may be included in these properties. The following are some additional advantages of purchasing a DST. Limited responsibility investors are shielded from personal liability resulting from the assets held in trust by DST laws. Without the additional risk of direct property ownership, investors can take advantage of the advantages that come with investing in real estate of the commercial caliber. Expanding and diversifying. Investors using a 1031 exchange can exchange into as many DST investments as are required to meet the like-kind replacement requirement. In an effort to better manage their investment risk, they can also exchange into a number of DSTs with various property types, such as senior housing or medical offices, or in various geographic locations. Timing. For investors attempting to complete 1031 exchanges and postpone paying capital gains taxes, timing is essential. Exchangers have 45 days from the close of the sale of their relinquished assets to formally identify like-kind replacement properties. But in competitive real estate markets, doing so is difficult at best and nearly impossible at worst. Due diligence, inspections, environmental reports, financial statements, rent rolls, and financing are all pre-packaged by sponsors in DST offerings, which can lower transactional risk. Exchange investors can quickly meet the 45-day identification deadline and conduct due diligence before the 180 days required by the 1031 exchange laws. Investment guidelines for Delaware Statutory Trust. Investors must work with a registered broker-dealer or registered investment advisor to invest in a Delaware Statutory Trust because DST interests are sold as securities. Only accredited investors are permitted to purchase DST interest. A person is considered an accredited investor if they have a net worth of $1 million or more and have earned more than $200,000 for the past 2 years, or $300,000 for married couples. Your primary residence's value is not included in the $1 million cap. Evaluation of DST sponsors. The DST sponsors are in charge of managing the day-to-day management of trust assets, the distribution of monthly cash flow distributions, quarterly reporting, tax returns, and performance evaluations of the assets under the sponsor's management are additional responsibilities. The management experience, core competencies in particular property types, geographic reach, underwriting expertise, and exit strategies of sponsors can vary greatly. In general, sponsors with a long track record enable potential investors to assess sponsor performance more accurately, particularly during economic downturns. Meanwhile, less experienced sponsors might also be viable. Just make sure to thoroughly investigate their background, particularly if they have experience with other kinds of real estate investments. Long-standing management groups may also be better positioned to use connections, resources, and insider information to buy assets and set up and promote the Delaware Statutory Trust. The management team of the sponsor should also be taken into account because larger sponsors can devote more resources to analyzing current and future properties and may be able to negotiate better loan terms and rates. Large sponsors may succeed in communication through regular reporting and asset performance updates. Prior to making any investment decisions, it is crucial to conduct thorough due diligence on sponsors and their offerings. DST investors can examine reviews from independent companies like FactRight to learn more about sponsors. If conducting this kind of research or property-specific research is outside of your expertise, you can hire an established commercial real estate investment company to do it for you. Where to look for DST properties? The properties included in each Delaware Statutory Trust that they propose are subject to review, acquisition, and management by national institutional real estate companies referred to as DST sponsors. Several parties conduct due diligence on the property and trust structure after the DST property has been purchased. When it comes down to it, the DST sponsors package the DST offering for investors and market it through independent brokers who have the required securities licenses to trade DSTs on behalf of customers. Each DST will typically own a single type of property, and a DST can own one or more properties. DSTs typically own high-quality institutional real estate which may provide more opportunity for income and capital growth. A DST might, for instance, own a portfolio of Class A multifamily apartments, whereas another might own an industrial structure, such as an Amazon distribution center or net lease real estate with corporately guaranteed retail tenants, such as Walgreens or Whole Foods. Finding a DST could be the biggest obstacle to investing in one. Due to SEC guidelines, not all DST investments can be directly marketed to the general public. To make offerings available to accredited investors, DST sponsors directly collaborate with securities broker-dealers and 1031 exchange advisors. Our qualified 1031 exchange advisors at Real Estate Transition Solutions carefully assess all DST sponsors and offerings to make sure the investment options offered are in line with the goals of our clients. DSTs are sophisticated investments, and in order to invest in one, you must be an accredited investor. According to the SEC, an accredited investor is someone who has a net worth of $1 million, excluding their primary residence, or an average annual income of more than $200,000 for the previous 2 years, whichever is higher, or $300,000 for a married couple filing jointly. Minimum investment for DST. A minimum investment in a Delaware Statutory Trust is typically $100,000, and an investor may purchase or exchange into ownership in one or more DSTs. Real estate owned by DST is typically held for 3 to 10 years. Investors receive all sales proceeds, including gains from potential appreciation, upon selling the property, and these funds can be exchanged once more to keep tax deferral going. Additional considerations for investing in a DST. Not everyone should make a DST investment. Before making an investment in a Delaware Statutory Trust, you should take the following factors into account. The liquidity. DSTs are illiquid investments that are best suited for people with long-term investment horizons because of their hold times, which range from 5 to 10 years. Passive investing beneficiaries are not involved in the ongoing management of businesses held in trust. While some investors might prefer this hands-off strategy, others who have extensive experience owning and managing real estate might not. Anticipated benefits. Return goals for DSTs are based on a variety of variables, including property type, location, mortgage balance, and interest rate. However, typical annual return goals range from 3% to 6%. Due to tax advantages and property growth, total returns may be higher or lower. Sponsor analysis and research. Not all DST sponsors are created equal. Working with a broker-dealer or a company with experience in DST investments can be beneficial for investors interested in buying DST interest, since it may be challenging for an investor to carry out the advised due diligence on their own. Investors can more effectively assess whether Delaware Statutory Trust are an appropriate investment vehicle for their needs by consulting with an experienced financial advisor, conducting independent research, and working with an investment firm with in-depth knowledge of commercial real estate. Delaware Statutory Trust benefits. The ability to postpone, minimize, or even completely avoid taxes associated with the sale of investment property using a 1031 exchange is arguably the most compelling argument in favor of investing in a Delaware Statutory Trust. DSTs are another well-liked passive real estate investment that provides ownership in properties of institutional caliber while minimizing landlord responsibilities. Delaware Statutory Trust as replacement properties in 1031 exchanges have the following benefits. Savings on capital gains taxes. DSTs are acceptable as a like-kind asset in a 1031 exchange. By doing this, real estate investors can postpone paying capital gains taxes on the sale of an investment property, frequently saving them a lot of money. As a result of federal, state, depreciation recapture, and net investment income taxes, capital gains taxes in some states can reach a maximum of 42.1%. Greater potential for income. DST properties are frequently designed with a focus on cash flow. DSTs can concentrate on seeking to preserve investment value and greater income potential for investors by acquiring high-quality institutional property in areas with strong projected growth. Depending on the type of property and investment thesis, the monthly income varies from trust to trust. But it's common for independent investors to be able to make more money each month through DST property ownership than through direct property ownership. Institutional-grade real estate. Although a DST can own almost any type of real estate asset, they frequently hold high-grade institutional real estate as their underlying holdings. Institutional-grade properties typically have the feature of high-quality assets in major markets and at price points beyond the reach of individual investors and smaller partnerships. They typically have the characteristic of sufficient size and stature to merit attention from large national or international investors. Lower quality assets are rarely eligible because of the strict requirements set forth by the IRS for a DST to be considered an exchange property. As a result, DSTs frequently own top-notch properties with Fortune 1000 companies as tenants that are creditworthy. These properties would be out of reach for an independent investor to acquire via a 1031 exchange if it weren't for the DST structure. Management of passive properties. DST investments are non-active. As a result, individual investors are not involved in running the DST real estate's day-to-day operations. Your work is finished once you choose a DST investment and obtain ownership. Investors can get rid of a management-intensive asset and landlord duties through a 1031 exchange without giving up the advantages of owning investment real estate. For independent investors facing significant changes in their lives, such as retirement, starting a family, or planning an estate transfer, this benefit is especially alluring. Diversification of risk. DSTs typically have a 100,000 minimum investment requirement, which makes it simple to diversify across various assets in order to reduce risk. investors can immediately diversify their holdings across various DST property types and locations by reinvesting the proceeds from the sale of an investment property into a number of DSTs under the IRS Property Identification Rules for 1031 exchange. Tax savings for beneficiaries of estates. DSTs have advantages for estate planning as well. Beneficiaries can postpone capital gains, depreciation recapture, and net investment income tax upon the death of an owner by stepping up their basis. For traditional, directly owned fee simple real estate assets, it is typically difficult for the estate to divide a DST investment seamlessly among beneficiaries. A CPA is able to discount a DST investment when determining the value of the entire estate because it's an illiquid investment with fractional ownership. Discounts between 20% and 30% are not unusual and can be used to lower conceivable estate taxes. Very low chance of exchange failure. Because the real estate has already been maximized and acquired by the DST sponsor, exchanges using DSTs rarely fail. The likelihood of a failed exchange is decreased by working with a well-known 1031 exchange advisor. All DST sponsors and DST properties are thoroughly vetted by Real Estate Transition Solutions. We think higher grade investment opportunities and a quality control process help reduce the risk of a failed 1031 exchange. Possibility of closing in 3 to 5 days. Investors can purchase the beneficial interest in the trust more quickly than with any other options for replacement property because the DST sponsor has already purchased the properties contained within a Delaware statutory trust. As DST investors can typically close within 3 to 5 business days following the sale of their relinquished property, this is ideal for a time-sensitive 1031 exchange or for those investors who value continuity in their income. A Delaware Statutory Trust drawbacks. Delaware Statutory Trust investment carry many of the same risks as other real estate investments, including the possibility of principal loss and lack of return. DST's performance as a long-term, income-focused investment is largely reliant on the tenant's capacity to pay rent. Lack of liquidity, interest rate risk, and shifting market conditions are some notable DST risks that are presented by this. Additionally, some DST characteristics such as the lack of individual control over the investment might not be consistent with a person's investment objectives. Absence of management oversight. Both advantages and disadvantages can come from a lack of management control. After all, one of the features that makes a DST such a desirable investment option is its passive nature. A highly skilled group of real estate experts is assembled by the DST sponsor to oversee DST operations. Some investors, however, would rather get involved in the management and strategy of the properties. The DST structure wouldn't work well for those investors. Limited liquidity. Usually, DST properties are held for 3 to 10 years. The duration of the investment and the exit are completely under the sponsor's discretion. The only way for an investor to exit the investment early is to sell their DST interest to another accredited investor. The investor would be responsible for paying the capital gains tax owed upon the sale if the sale did not comply with the same 1031 exchange rules. Be aware that some DSTs include liquidity through a 721 up REIT. Changes in rates and regulations. Investors may be subject to future interest rate changes and vacancy rates, as with any income-oriented real estate investment, which could limit potential cash flow and price growth. DSTs are also subject to adjustments in how the IRS handles tax-deferred exchanges. Workings of a Delaware Statutory Trust. From the perspective of an investor, Delaware Statutory Trust might present a quicker and less challenging closing process than other passive real estate alternatives. A DST sponsor is accountable for finding, acquiring, and maintaining the DST properties to be included in the trust. The investors own a beneficial interest in the trust, which holds the title to the real estate. DST businesses. The real estate company backing the trust is a DST sponsor. To find and purchase the properties to be included in the trust, DST sponsor use their own balance sheet. Before deciding on the best property for an offering, the DST sponsor will carefully examine a number of properties. The DST sponsor can simultaneously serve as the trustee, manager, and master lessee, as well as create the offering in the property for accredited investors. In order for DST investors to enjoy passive ownership, the DST sponsor typically arranges for a subsidiary to serve as the master tenant to lease and maintain the assets of a DST and enters into a contract with a qualified real estate management company to handle day-to-day operations of the real estate. For the purpose of obtaining the equity necessary to fully fund the offering, the DST sponsor will market the DST offering to broker-dealers. To make sure the DST sponsors and their offerings are appropriate for the registered representatives to offer to their clients, the broker-dealer will perform due diligence and analysis on them. Federal and state regulators view DST properties as securities. Registered representatives must possess particular securities licenses in order to offer the DST property to accredited investors. DST organization. DSTs are designed to be completely passive investments. While investors do hold a small portion of the real estate, the DST sponsor is in charge of all the intricate tasks, such as managing the trust, finding accredited investors to meet any remaining equity requirements, and monitoring the performance of the trust's assets. DSTs are strictly governed as a 1031 exchange qualifying transaction. The criteria for a DST to be eligible as a replacement property in a 1031 exchange were established by IRS Revenue Ruling 2004-86. The following 7 characteristics, sometimes known as the 7 deadly sins of a DST, are shared by all Delaware statutory trusts and have a consistent DST structure. After the DST offering closes, no new capital contributions are permitted. There can be no further capital contributions from either current or new beneficiaries after the trust offering is closed. As a result, the DST trustees are unable to request additional funding from the investors. DST loan terms cannot be renegotiated by trustees. Until a default result from tenant bankruptcy or insolvency, trustees cannot renegotiate current loan terms. Trustee sales proceeds from DSTs cannot be reinvested. The trust's real estate cannot be sold, and the proceeds cannot be reinvested by trustees. The investors must receive all of the proceeds. Standard repairs are the extent of capital expenditures. Trustees are limited to investing in the underlying real estate for routine upkeep, repairs, and non-structural capital improvements. DSTs are thus unable to own real estate used for speculative development. Short-term debt must be purchased with cash reserves. The trustees' cash reserves can only be used to buy short-term debt. The trust investors must receive any leftover cash proceeds from the property sale. Beneficiaries must receive payments in cash on a regular basis. Except for required reserves and working capital, all funds must be distributed to beneficiaries on a daily basis. Leases cannot be renegotiated by trustees. Except in cases of tenant bankruptcy or insolvency, the trust is not permitted to sign new leases or restructure existing ones. Despite the fact that all DSTs follow these legal requirements, not all of them are the same. Different DSTs have different property types and quality levels, portfolio sizes, master lease agreement terms, and sponsor quality. Investors should take note of each of these details when deciding on and researching a potential DST investment. Paying DST. A DST must pay several underwriting and administrative fees when purchasing property and setting up the trust, just like with any other investment. At the time of the offering, these expenses are repaid to DST sponsors. The following are a few of the most typical fees, but they're not all of them. Purchasing sponsored property with due care, reports on the structure of reserves, origination fees for loans, cost of marketing and distribution, acquiring a tax opinion letter to verify that the trust is eligible for 1031 tax-deferred exchanges, obtaining a due diligence report from a third party. The sponsoring entity is prohibited from taking part in any potential appreciation of the trust's real estate upon sale, according to the IRS-mandated framework for DSTs. Therefore, in addition to the acquisition and structuring fees, DST sponsors may also be entitled to a portion of the property's ongoing net operating income. Process for exchanging to 1031 DST. In most cases, the first step in the 1031 exchange process is determining the tax liability on the property you've given up. Before selling your investment property, think about speaking with a 1031 exchange advisor to make sure you are following the regulations, have a clear understanding of your tax obligations, and can find suitable DST properties that will help you achieve your financial and lifestyle objectives. The following are the top 10 reasons why people are substituting DSTs for their 1031 exchanges. Number 1. Potentially higher cash flows and overall returns. Many real estate investors might not be making as much money as they believe. An investor can calculate their cash flows by first subtracting the principal portion of their payment, adding back depreciation, and then taking their net rental income from their Schedule E. Then multiply that result by the property's market value. For instance, the net amount would be $50,000 if there were $50,000 in net rental receipts, $10,000 in depreciation, and an additional $10,000 in principal payments. The investor would have a 5% cash flow if the property were valued at $1 million. DSTs may provide an investor with a passive alternative while also providing a better cash flow and risk-return profile. Number 2. Tax planning and maintained basis step-up. DSTs provide the same tax benefits as real estate that an investor would personally own and manage. The proportionate share of depreciation and amortization is distributed to DST investors. DSTs may be exchanged into another DST in the future through a 1031 exchange. DST hold times typically range between 5 and 7 years. When considering DSTs as a potential option for your 1031 exchange, consult your tax advisor for additional information and tailored tax advice. Number 3. Diversification. Multiple assets are owned by many DST holdings under one DST structure. One apartment building might be traded in for a portfolio of 10 to 15 Walmart stores, Walgreens, and other single-tenant triple net leases inside a DST structure, by way of illustration. Number 4. No longer necessary to oversee properties. A client who is aging and no longer has the energy, time, and desire to manage their own real estate investments comes up from time to time. While maintaining the desire to invest in real estate, DSTs can be a great passive option. Number 5. Older real estate owners who use passive investing have more time and freedom to travel, pursue other interests, spend more time with family, and/or relocate far from their current real estate holdings. Number 6. As a fallback plan, an investor might have trouble locating a suitable replacement property for their 1031 exchange in a competitive real estate market. If for no other reason, DSTs are a fantastic option and ought to be named or identified in an exchange. A real estate investor has 45 days to find a replacement property and 180 days to close after selling a property before the IRS disallows the tax-free exchange. Number 7. Gain equity in a competitive market. Investors may want to take their gains off the table and reinvest using the leverage in a DST offering when markets are at all-time highs. Number 8. Take care of the family. When only one spouse is capable of managing real estate investment assets, a family may be at risk. Passive DSTs effectively outsource management, which can safeguard a family in the event that one spouse loses the ability to look out for their own interest. Number 9. Become passive to avoid ongoing repairs on actively managed property. Real estate investors are aware that they might eventually need to replace pricey roofs and air conditioners, fix a foundation, deal with potential legal issues, and incur other unforeseen costs associated with real estate investing. Investors may be protected from these kinds of unforeseen costs by DSTs. Number 10. A key aspect of estate and retirement planning. DSTs can provide a variety of options for estate, tax, and retirement planning. DSTs offer investors and their retirement planners a number of opportunities, including passive income, the removal of personal liability, freedom, the ability to manage cash flows, and wealth transfer. That's it for this video, Real Talker. Remember to subscribe to our channels, and if you feel like we've delivered value, please share this video with one person. That's right, just one person as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!